All right, folks, welcome back to Dirty Boots Capital. Today we have the amazing Neal Bawa with us today, and I'm so excited. Neal, thank you for joining us.
Thanks for having me on Dirty Boots. I love the words Dirty Boots because it immediately creates this vision of what we do. A few days ago, I was tromping through a site in Raleigh and I got ticks. 3 of them bit me. I mean, that's Dirty Boots. This is the life that you're going to be living if you do this. Sometimes when you're going through properties, you go through very dirty areas like units that are down and there's roaches in there. It's not all sexy. I know it's sexy, but it's not all sexy. So I
It's
love the
not
name.
all sex. It was, with purpose that I named my company Dirty Boots Capital because it's getting your boots dirty in the field, walking properties. If you're doing new construction, ground up construction, something like that, really getting your boots dirty that way, or doing inspections when you're looking to buy a property through your due diligence. But it's also getting your boots dirty, walking through demographic reports, walking through financial reports, understanding what's really happening in that location. You get it, Neal, because you're amazing. I mean, for the audience, if you guys don't know Neal, which I'd be incredibly surprised if you don't know Neal because he's all over the place. He's known as the mad scientist of multifamilies. He's a technologist. He's a self-proclaimed geek, which I love because I'm a geek as well, as you guys already know. And he's a data guru. So we're going to be talking about some of the data that he's looking at. But Neal also runs Grow Capitus. He invests in multifamilies with his investors. They have a $700 million multifamily portfolio. So he knows this well. And that's why I wanted to get him on because he has such great experience to help us learn some different things that are happening out there. And then if that wasn't enough, right, he's already a rock star just doing that stuff, right? He's also CEO of Multifamily University. So we're going to talk a little bit about that as well. Neal, again, thank you for joining us. Welcome to Dirty Boots. And I want to just take a 50,000 foot view. Let's start with that of just kind of the macro landscape out there. What's happening that's affecting real estate investing these days? I read so many stories and see so many things about, office space is, man, those office buildings are going to cause a crash in the commercial real estate market. And okay, maybe. Is that what you see? I mean, what about, is that going to domino us into like a 2008 style foreclosure market with homes and other multifamilies? What do you see happening with the interest rates? Are they going to stabilize? Are they going to go lower? And also unemployment. Unemployment has been incredibly low for so long. I've been looking around waiting for it to go higher, more layoffs, but I'm not seeing that. So I'm totally confused what's going on. I'd love to get your macro view on all of that.
We'll go back and forth between real estate and economy, right? Because I don't like to do too much economy or too much real estate. It's nice to go back and forth. So first, I'll basically pick an area that is a real challenge, but not in a challenge in the way that people think about it. So there's a ton of information about commercial real estate. And when they say commercial real estate, remember the biggest component is office. Now, some people use the word commercial real estate to include multifamily. Technically, it doesn't, but sometimes people include it in there, and that's fine. There's a lot of, well, CRE debt is maturing in 2024. I've heard these numbers like $1.4 trillion is maturing. And then they say, well, there's all this bad stuff happening. So they imply that somehow all of this $1.4 trillion is at risk. Nothing could be further from the truth. Okay. So firstly, before we continue, let me take 60 seconds to tell you about Multifamily University. Are you ready to take your real estate investing to the next level? Look no further than Multifamily University. Our comprehensive resources, including guest podcast appearances, educational webinars, the Real Estate Trends Toolkit, and the Location Magic course, are all designed to make smart investing easy and accessible. Plus, with no subscriptions, no upsells, you can trust that we're always looking out for your best interests. But don't take our word for it. Check out what our satisfied customer, Carlos M., had to say. Neal's presentation was filled with invaluable information that is not readily available to the average investor. This group takes you to the elite level of investing. Join the ranks of the elite with Multifamily University. Join us at multifamilyu.com and start investing from a place of knowledge today. Not only will you have access to a wealth of knowledge from industry experts, but you'll also be able to stay ahead of the game with our in-depth analysis of market trends and potential recessions or corrections. Invest with confidence and make informed decisions based on data, not gut feel. Don't miss out. Visit us at multifamilyu.com today or click the link in the description below. And now, back to the content. understand that the only asset class that is not seeing loan deferrals is multifamily. So I'm going to give you some numbers. So imagine a pie. It's at $1.4 trillion. Now, if $1.4 trillion was truly in distress, absolutely, we could see a 2008 type event. But let me give you some numbers that explains why really the real number is a tiny fraction of that. There are $206 billion of office loans coming due this year. So it's one of those bars in that $1.4 trillion. Of them, 89 billion have already been deferred in the first 5 months because banks don't want these assets back. If you have an office asset and you're doing a fairly decent job with it, you know that your asset is obviously worth less than the market. So, if you basically give it back to the bank, it's terrible, but you're doing a good job. Your, property is 90% occupied, which is a good number for office. No bank will take your property back. Once again, out of $206 billion in loans, here we are in May, right? Or in June, beginning of June, already 89 billion have been deferred. So the banks are doing a very good job of kicking down the loans because they don't want any office, asset back. Industrial.
And I think that's also lessons learned from 2008.
2008, right?
When
2008, the banks were too quick to call in the single family,
foreclose.
and then they ended up with 2 million single families that they couldn't sell.
That's right.
So the banks have learned from this. That there's this feeling that the banks are inept. No, they're not. They learn from their experiences, right? The banks are pushing it down. Now, what about hotel assets? Well, same sort of situation. Hotels are actually in a great place where their average daily rate is gone up tremendously. I can give you exact numbers on that. But the point is, cap rates for hotels are affected. So if the hotel goes back to the property, well, that cap rate's going to apply and the bank's going to be in trouble. So out of $105 billion of hotel loans that are coming to due, here we are, halfway through the year, 45 billion have already been deferred. Almost half for office, almost half for hotel. Same thing applies for industrial. Out of 110 billion, $48 billion have been deferred. Ironically, the two markets where loans are not being deferred by banks happen to be retail, that market that I've been bashing for 10 years, turned out to be wrong there. And I'll tell you why I was wrong for retail. So if you look at multifamily bars for how many units we are delivering each year, those bars have been going up for 15 or 20 years, right? So 15 years, bars are going up. And they sort of declined a little bit in 2009 and 10 and then started going up again. Now, imagine retail going up until 2009. And then everybody started realizing this word retail apocalypse because of Amazon. And then imagine that in 2010, 11, and 12, the bar just drops to like a third. And then really never comes back over the last decade. So inventory in retail is so low that retail right now has the lowest vacancy that it had had in the last 30 years because people haven't been building enough retail because they're afraid of building retail. On the retail side, out of 71 billion loans coming due, only 8 billion has been deferred. Now, the asset class that is the strongest of all, but again, which makes sense, your viewers should know this, is multifamily. There are $257 billion in multifamily loans coming due in 2024. 2 billion have been deferred. 2 billion. Now, this may seem like bad news because it's like, no, I want more of this to be deferred. No, you don't. Because what that indicates is that the banks have complete confidence. They have confidence that if a property comes back to us, we'll sell it in 45 days, right? And so the banks are not willing to lose $1 on multifamily. They're like, no. I'm not going to give you a lower interest rate. I'm not going to give you a deferment. You want to return your property if you be my guest. That is actually a huge vote, a $257 billion vote that only 2 billion in multifamily has been deferred in the first half of this year. That's what you should understand. So people are like $1.4 trillion. Why? Because somebody said it on Twitter or somebody said it on TikTok. The question is, why don't you go find data on that to see where's the distress? Where's the problem? I think even with $89 billion of office loans deferred, still we are going to see problems in office. But it's a very slow moving process. Office is in a real apocalypse, but it's very slow moving, average lease, 5-year long, 5-year lease.
And you mentioned I think a couple of times there, a very interesting word, distressed, right? Distressed property. Now, when I look at multifamilies, right, there's such a need for affordable housing. There's such a need for multifamilies. I don't necessarily see the multifamily space as being a distressed asset. Now, what we do have is operators who don't always operate the property in the best way possible. So when there's distress in the multifamily space, it's not with the asset itself, it's actually distress with the operator who's not really performing as they should. That's how I see it. Is that how you see it, Neal, or what's your take?
Absolutely. So the word distress is being misused when it comes to multifamily. There are 19.6 million multifamily units in the United States, 19.6 million apartments. Call it 20 million, okay? There's 20 million in Yardi, 20 million in Costa. Of those 20 million, let's assume that every building is 200 units, just to make math simpler. That's 100,000 buildings. The total volume of distressed buildings in the United States is either 2,500 according to Yardi Matrix or 3,000 according to CoStar, right? So depending upon who you're looking at, 2,500 to 3,000 are in distress. That happens to be, my friend, either 2.5% or 3% of the market.
Yeah.
So all we can say is somewhere between 2.5% and 3% of the multifamily market is distressed. The multifamily market is not distressed at all. Today, if you're selling a 95% occupied property, you will get, and you do a good job of marketing it, and there's nothing wrong with the property, right? It may not be worth what it was 2 years ago. It's probably worth $10 million less. Doesn't matter. At least 20 people will show up. There will be lots of best and final. And there will be at least 3 people putting down $200,000 hard on day one, not sight unseen, without even actually, doing 30 days of due diligence. Because you still today, right, in June 2024, cannot buy a good looking, decent multifamily property, Class C or Class B, without putting money hard on day one. There is absolutely no way a distressed asset class would have money hard on day one. Let me give you an example of distress. You know what is distressed in the United States right now? Land. Land is distressed. Why? Because developers have dropped the number of permits. Developers have dropped starts tremendously because multifamily prices have gone down 25%. It hasn't happened on the single family side, and I'll explain why in a minute. But on the multifamily side, starts are dropping. They dropped 30%. Now they're dropping another 20%. So we're down almost 50% in starts. Well, that means 50% of the land is no longer available for sale. So land, because it still has costs like property taxes, right, but has no income, unlike a multifamily property, all of a sudden people are like, oh, I gotta get rid of this, right? Because people have been buying land at ridiculous prices. And now all of a sudden that land is delinquent. Right now, you know what I'm doing? I'm obviously buying value add properties, and you'll learn more about that today. But you know what I'm really doing is I'm not buying land. I'm squatting on land. I have a team of people that has processed 4,032 parcels. My last meeting before I came to this podcast was that one. So I remember that number stuck in my head. 4,032 parcels, have underwritten 300, have made over 100 offers, have about 27 deals that they're working on, of which 4 are in contract and 3 are in LOI. You know why I can do 7 deals at once? I mean, I'm not that rich. I can't do 7 deals at once because each of these deals is 2% down deposit with a 21-month close. That's distress.
Yep.
That's distress. Nobody, if I had even asked for 5 months close 2.5 years ago, people would laugh at me, right? I would get F-bombs in my email.
I think that how you walked us through the definition of distress is so valuable for us as real estate investors, right? The viewers, the listeners out there. It's so important for us to understand distressed, and it's certainly not in the multifamily space. And I'll come at it from a different perspective. I work with family offices out of New York, New Jersey, right? These are family offices that have generational wealth that they're looking to place. These folks are sitting on the sidelines in some cases with money, waiting for the right property to come along.
They are. But let me tell you this, okay? So I'm not a fan of this whole thing. There's a lot of money sitting on the sideline because what I find is that people, if you look at the last 10 years, every year people were saying somebody's sitting on the sidelines. Well, the price of multifamily is now down 25%. If you don't understand that the price of multifamily is down 25%, you don't understand how multifamily works. I am not saying that the price per unit is down 25%. It's not. The price per unit is actually maybe down a few percent, maybe 5%, 10%. But over the last 18 months, last 2 years, net operating income has increased in properties slowly, but has increased in properties. So when you compare pricing, when you say something is down 25%, the only way to tell that is to look at the cap rates, because cap rates are independent of price per door. So I can tell you that there are certain markets in the United States, at least 2, where the price per door has actually slightly increased in the last 2 years, price per door. So if it was 110, now it's 112. But those markets are down 25% because NOI was very strong in those markets. So over the last 2 years, net operating income increased a lot, but price per door only increased $2,000. What if the price was going to stay at the same level, then it would have been $130,000 a door, $140,000 a door. So a lot of people are like, prices have not decreased, and you don't understand how to do multifamily math. Multifamily math is based on cap rates. Cap rates in every major market in the United States are down 25%. As of June 2024 from peak. And there's also people who are like, well, in 2017, I had this cap rate and that's the same cap rate today. Yes, we've returned back to 2017 cap rates. Why? Because in 2018, rates were low, cap rates were lower, prices were higher, and then lower, and then lower. And then in 2021, the world went insane. And in March 2022, we reached the peak cap rates, by the way, that means the bottom of the cap rates, because that's the peak price, right? So the lowest cap rates we had was in March 2022, which is basically 2 years and 3 months ago. So from peak, we're down 25%. But if you look at 2017, we're down to the same level as 2017. And so people just don't have an understanding of this mathematics, that every market, multifamily is down 25%. And today I see this ridiculous disconnect between investors and the real market in two different ways. Okay, I'll explain disconnect number one and disconnect number two. The first disconnect is all of those investors that have been burned in the last 2 years, they're hesitant to put money into multifamily. And I want to say the following things to them. You're making the exact same mistake that you already made in 2008. When I was buying a property every month in 2008, 9, and 10, all of you were telling me that I was an idiot. I ended up with $10 million worth of property because it was so cheap, right? It made all sense in the world. The math made sense. I couldn't care less about what its old value was. So in the same way, I don't care less, and you shouldn't care less about what happened 2 years ago. 2 years ago, when folks like me were telling you in podcasts not to buy property, you were throwing money at it, right? Well, those properties were expensive. Well, they're 25% cheaper now. And not just that, 2 years ago, everyone had to underwrite 3.5% rent growth to win a property. Today, people are winning properties with 2.5% rent growth. So it's not just the price that we're paying. It's the fact that we're able to moderate our assumptions and still win deals. So all of the things that you wish had happened 2 years ago have happened today, but you're afraid of investing money because of what happened 2 years ago. This is called recency bias. And it's the biggest reason why investors are not investors, they're speculators. Today, prices are lower. A lot of people are actually getting deals that are amazing. And I'll tell you, those people, when you see one of those deals, you have to go for it immediately. I'm heavily investing in as a passive investor right now, like 100,000, because I see one scenario where I can't lose. And that one scenario is as simple as this. Prices are down 25% for one reason, right? And that reason is because interest rates are up. No other reason. Everybody wants multifamily, right? There's no change in demand. This is not office. So that one reason is you have to deal with high interest rates. Well, what if you could buy a property that has a locked in 4% rate for 5 years? Now you're getting the 25% discount without having any exposure to interest rate.
That's right.
So when I see a property from a good syndicator, and a good syndicator says my rate's locked in for 5 years, I'm like, this is the only time that this can happen, because 2 years from now, if rates come down, prices will go up. So you'll never get this chance again. But because you're assuming someone else's loan that's locked in for 5 years, you win. To be honest, and I hate saying this because there's a lot of underwriters here that are going to flame me for saying this. Today is one of those rare times when you can get cap rate arbitrage, because the only direction in which cap rates can go right now is lower. They can't go higher, right? There's people who think cap rates are going to go up, and they simply have no understanding of mathematics. 2 years ago, when I was saying cap rates are going to absolutely go up, people are like, no, there's too much demand. There's people sitting on the sidelines. Well, it doesn't really matter, because those people sitting on the sidelines, they're much smarter than all of us. And sometimes they sit on the sideline for 10 years. Right? Because it's institutional money. And institutional money is, they're looking for 10 to 11 IRR. And their IRRs are higher because what they do is they time the market really well. They buy when the market is extremely low, and then they sell when it's extremely high. And that could be 3 years, 5 years, 7 years, 10 years, 15 years. Because they have no time horizon, they often make more money than we do. But that also means that a lot of the time their money is just liquid and sitting around doing nothing, and they're okay with that.
Yeah, and that's the thing with some of the family offices. They're okay with just having it sit, because they're just looking for that 10%, not the 20 or 30% that sometimes we can get. I appreciate that perspective, because I do remember, 2-3 years ago when people were buying properties, like I'm in the Northeast, and I remember seeing cap rates, people buying properties at cap rates of like a 1.5. And I'm like, are you insane? How is this a good investment at a 1.5 cap rate? It was just absolutely crazy.
Just for the viewers, I wanted to, because it's such an absurd example and it's true, right? I saw multiple, I live in the San Francisco Bay Area, right? All of these.
Oh, you probably saw it too.
Right?
Yeah.
So just so you understand what a 1.5% cap rate is, take 100 divided by that number, and you basically end up, or 100, 1.5 divided by 100, it will take roughly 66 years for you to return your investment. That's what 1.5 cap means. 1.5 multiplied by 66 is 100. So what you're saying is, I'm okay with getting a return in 66 years.
Insane.
And even today, I mean, when you buy a property at 5 cap, let's say you don't use any leverage, you just, you're a cash buyer. What is 5 cap? 5 cap means 100 divided by 5 equals 20. You're basically going to see a return, a full return in 20% because you're making 5% a year, 5% a year, 5% a year. So it'll take 20% for you to make 100%, right? That's what 5 cap means. Cap rate takes all of the interest out of the equation because the interest vary. 2.5 years ago, it was 3.2%. Today it's 7%. It's going to go up. It's going to go down. You're going to refinance. So to know whether you're buying a property at a certain price, you must absolutely eliminate interest and look at it from a cap rate perspective, which is why when people come and tell me prices haven't declined on a per door basis, so this 25% discount that you keep telling me is not real, my answer is it is real in every market in the United States. There are maybe a couple markets that are sort of low teens, and my feedback is they just haven't gotten there yet. Some of these markets didn't have a lot of supply, so it's taking them longer to get to that 25% number.
So let's talk about some different markets. Where are you seeing, that certain markets are overbought, and where are you seeing some markets that still have some opportunity, some juice left to squeeze, so to speak? What are you seeing out there?
Right now, there aren't a lot of overbought markets anyway, because if people are coming to the marketplace, there are less buyers. I'd say there's probably a third less buyers today than there were 2 years ago, and prices are also lower. So some of those buyers are able to spread their money around. Where I was buying 2 properties, now I can buy 3, that sort of thing, right? So if you're an active buyer, you're in a great place. I'm just looking at the markets that are still seeing negative rent growth. So the first thing is that negative rent growth is happening in a number of Southeast markets in the United States. So this is a good time to be making offers in markets with negative rent growth, because you know how brokers basically say, oh, property should be worth this much because all this rent growth. Well, if the rent roll is showing that rents have gone down 3%, the brokers have to be very moderate. That's when you get good deals. So the market, ironically, that is one of the best places to be putting lowball offers today, is actually the hottest market in America over the last 5 years, Austin. Because Austin is seeing a 6% decline in rent growth. And in case you're wondering, is that bad for Austin? No, it's not, because Austin had 30% rent growth, or almost 30% in 2021. So it's moderating just like other markets, but it was so high that it's coming down. Same thing with Phoenix. Phoenix and Austin in the second half of this year and the first half of next year are good markets, because the negative rent growth means that people cannot set very high expectations for sellers. And so you're in a good place. Now, there's a downside. And that downside is Phoenix and Austin will continue to have high supply throughout the rest of this year into Q1 next year, because they are some of the markets that are taking longer for that new supply to be absorbed. So when you buy a property, let's say, it's June now, let's say you buy a property and on October 1st, expect that your first 6 months are going to be tough. And I think you should take that on, because at the end of that point, now those markets are going to start their inevitable climb, because as it happens, Phoenix and Austin are 2 of the best markets in the US. Nothing has changed demographically for them. It's just there was too much inventory, and so rent growth's negative. Now, it's not really that negative in Phoenix. It's probably more like negative 2 or 3%, where Austin's the sort of the poster child of negative rent growth at 6% negative.
So maybe some opportunities there in those markets, and just having to wait it out, so to speak. I saw something on your Instagram. For the folks out there, if you're not following Neal, go to Instagram, look him up, give him a follow. He has really great content out there. You said something on there that gave me pause, and I just started to really think about it, because it's something I haven't heard anybody else say, and there was some brilliance in there. I'm gonna give you that credit. It was about these negative rent growth areas, and you had said 2024 was not the year to make money in some cases. Raise your fees, but don't raise your rents. Buy, B-U-Y, buy occupancy.
Yep.
With that mentality. Can you help us understand? I want to be mindful of your time. We got another 15 minutes, but I mean, I thought that was pretty and impressive, and give me some something to think about. So buying occupancy, what do you mean about that?
So everything's an arbitrage in multifamily. So you can either get, higher rent numbers, or you can get higher occupancy numbers. You have to understand how your lenders think. 2 years ago, lenders were happy if you were at 89, 90% occupancy, but your rents were above your budget. So you was like, this is the budget I've sent, my rents are above this. I'm really pushing. And when you push, people leave because they can't afford it. And so I'm going to have, these lower numbers. Today, you cannot do that. Today, your investors are much more skittish, and your banks are much more skittish. Today, you take a lower rent growth number and you get your occupancy up to 95, 96, 97%, because a year from now, you can raise rents. Rents are, obviously when we do underwriting, we say, I'm going to put in a 2% rent increase or a 3%. Those are common numbers. But if you look at rent growth over the last 10 years, there's no 2% years. It's either high or low, and high and low. And it sort of goes ziggy-zaggy, right? It's extremely ziggy-zaggy. You can capture all of the rent growth that you're losing in 2024 and 2025. And it is for the same exact reason that you're losing it. The reason why you're losing rent growth this year is the reason why you're gaining it next year. And that is supply. Supply is the X factor. The United States has the potential of having 672,000 apartment units delivered this year. I think there might not get that far, might be 550, whatever. But our absorption, which is extraordinarily strong right now, is still only 409,000, right? Yeah. That's a fantastic number, by the way. It's 409 is like, wow, I love it. I'm in the apartment business. Yes, but you're delivering 550. So this is the peak of your delivery. Now, here's the good news. It started to go downwards beginning of 2023 because, rates started going up and so started going down. And so if you started less in 2023, then you're going to deliver less in 2025, especially in the second half of 2025. The first half is not as affected. The second half is affected. So in the second half of 2025, you go from having a glut today in June this year to having next July, having an actual shortage. The swing is going to be like 250,000 units a year. That's a big number. Now, all of a sudden, you can go from 2% rent growth at 95% occupancy back to 10% rent growth. Let's bring our occupancy down to 90%, get rid of the people that can afford, and the next cycle starts. Yeah. This is the way business is. There is no steady state. You're either up, you're down. Right now, focus on occupancy, because if you want an extension from your bank, occupancy looks 1,000 times better than rent growth.
And I love that short-term perspective versus long-term perspective. Short-term today versus long-term in 2025. What does it look like for rent growth? So I appreciate that perspective. Thank you. I want to get your perspective also on, we all know real estate should be part of our portfolio, right? Stocks, bonds, real estate, all sorts of good stuff there. And so one of the questions I get asked quite a bit, and I'd love to get your perspective, is whether somebody should be an active investor or a passive investor through like a syndication, right? And today there's so many different complexities, much more so than when I started 20 years ago in real estate investing. So there's so many more complexities with even just finding a property can be difficult these days. Financing that property can be difficult. Finding the right insurance carrier, right? Insurance companies are dropping out of multifamilies right and left. There's a lot of complexities. And so today, where do you see, folks should position? Should they really be active investors or should they be passive investors with other groups that have been doing this for some time?
This one gets me in trouble because I don't agree with the rest of the industry. The rest of the industry says people who do this on a full-time basis are going to be superior to people who basically do this as part of their job. You're right. But my advice is be active, because you are a much better passive investor when you've been active. You simply cannot have a proper understanding of the business unless you've been active once or twice. And maybe you'll do well and maybe you won't. And in both cases, you'll benefit, because I think that this is the education that is needed to be a better passive investor. You also will be a happier passive investor because you won't panic. Because when you're an active investor, you go through these ups and downs. You go from 100% occupancy in a single family to 0, and then 100 and 0, and over time you sort of understand that it evens out. And so if your syndicator's apartment complex loses 10% occupancy, you're not all of a sudden flipping out. You're not going crazy, right? And so you have to understand everybody has bad quarters. Apple just had a really bad quarter because iPhone shipments in China were down 24%. Yeah. Well, they're still a $3 trillion company. They don't panic, and you shouldn't panic either. I find that the people that have been active are actually better passive investors and happier passive investors.
And they actually see where the opportunities exist because they're willing to lean forward today and not really take a big cut, a big return on that investment, because they see where that opportunity is in 2025 and 2026, right? So they're better investors from that perspective. And so I appreciate your perspective on that. And so you mentioned this idea of education. This is where I want to sort of end, because we're pushing our time limit here. Where do you see the value in terms of continued education? And that could be anywhere from going to conferences, taking additional courses if you're a real estate investor, or hiring a coach or a mentor, going to mastermind groups, things like that. Where do you see the value in do you see value in continued education?
I do. And I think this is a general comment. So I'm generalizing over a large audience. What I find is that, firstly, I go to conferences, and a lot of times, the people at that conference are there to learn from me, right? So I present at about 20 conferences a year. But what I find is, even though I may not necessarily have new aha moments at conferences, because I'm involved in my frame of mind, I'm away from the office. I'm away from the regular grunge of underwriting properties and going to asset management meetings. And I find that there's all kinds of interesting, good things happen to my business because I'm away. And so sometimes I'm lazy and I don't go, and then I regret it later because my business basically stagnates. So for somebody that's been in it for 20 years, years, I'm getting the benefit, still getting the benefit, just from a different perspective. But the
Yeah.
people that are new to it, having this top of mind is very important, because the drive, that initial push to make something happen, rarely happens sitting in front of a computer. Podcasts are good for initial learning, to basically
Mhm.
build a foundation for learning. But I'm a great believer that you need to go to, a mindset event, mastermind, or a conference, and it is a completely different experience. And I don't believe, certainly over my experience of 20 years, I don't believe that the value of it has declined for me. It's just different.
And for folks starting out, you don't need to join a $100,000 a year mastermind. They're out there. You can, but you can just simply go to your local real estate investment association group that many communities have, and they're low cost. They're 100, 200, less than $500 a year to attend one of those. They have monthly meetings. You get to meet other local real estate investors who are trying to do or have done exactly what you want to do. And so being able to network, whether it's at a real estate investor conference or whether it's at your local real estate club in your local
Yep.
neighborhood, all those things are great things. I encourage the viewers, if you're just starting out, take a look at some of that stuff because it's super important. I mean, also take a look. Neil, obviously, he has his multifamily university, which offers courses, all great stuff. Neil, why don't you tell us a little bit about that?
Sure. I love Wikipedia. I have been contributing to Wikipedia since the year that it started up because of the unique nature of the model. I use it a lot. I like the fact that there's people curating. So I had this vision a long time ago where I wanted to be the Wikipedia of real estate. And eventually we called it Multifamily University. The name's terrible because it's really a real estate university, but I'm more in multifamily, so I call it Multifamily University. And so the vision became to provide education that is extremely high quality. I want to be the top 0.1% in the industry in terms of quality, but it has to be free. It has to be completely free. It cannot have a subscription-based model. It cannot have an upsell. It cannot have an educational package, because while there are many people doing education in the industry, I like doing things. I like building buildings. I like fixing buildings. That is my joy. What I like education for is simply providing people with aha moments. And, hopefully, I provided some today. And while I was talking, not every number is memorized. When I told you Office had 206 billion with 89 billion dollars, deferred, that's an actual PowerPoint that's sitting on the right monitor for me. What I like to do, my way of providing education, is either on podcasts, which I love doing because it's just free form. And then what I do is I write 12 bespoke presentations every year. And these have 40 to 50 slides, and they're an hour long. I stay on each slide for 1 minute just to sort of pick the juice out of it and say, this is what I see. And then I move on. And I do these kinds of presentations on all kinds of stuff, multifamily and student housing and built to rent. I also do them on things connected to real estate, like impact of climate change on real estate, impact of artificial intelligence on jobs, those sorts of things. And then we also teach techniques. So for example, we do one that talks about the best practices of asset management. Another one talks about the best practices of acquisition. And a third one, which is our most popular one, talks about 10xing your businesses using virtual assistants. So I have an army in the Philippines, full-time employees. There are usually between 23 and 35 people in the Philippines that work for us on a full-time basis, 3 years, 4 years, 5 years, average stay time. And it's an incredible army. So we teach a course about how exactly to build that army. Once again, we have no educational packages. We'll never charge you a buck. There is no upsell. There's no subscription fee. All that happens is you join our ecosystem, which means that 4 times a year when we have deals, we'll send you an email.
Tremendous value there, and tremendous value here on this podcast, helping us understand what you're seeing in the market, not just at the 50,000-foot view, but also, boots on the ground, what you're seeing happening today in the multifamily space. So, Neil, I so appreciate having you here on the Dirty Boots Capital podcast. Thank you so much for being with us. For folks that want to connect with you and learn more about what you're doing, where's the best place for them to reach you?
Start with Multifamily University, which is multifamilyu.com, or I happen to be the only Neal Bawa on the World Wide Web. Simply Google my name.
Excellent. Neil, again, thank you for being with us. Truly appreciate it.
Thanks so much for having me, Tony.